Welcome to our deep dive into credit rating and the evolution of risk in India. In today's financial world, understanding credit rating is essential for investors, companies, and regulators alike. This video will guide you through the concept, scope, and significance of credit ratings, the benefits they offer, the regulatory framework in India, and the processes followed by leading credit rating agencies. Let's start by exploring what credit rating really means and why it has become a cornerstone of modern finance. Credit rating is essentially a quantified assessment of a borrower's creditworthiness. Whether it's an individual, a corporation, or even a government, credit ratings help determine the likelihood that a borrower will be able to meet their financial obligations. These ratings are not just numbers, they represent a comprehensive analysis of financial health, past borrowing and repayment behavior, and overall risk. This makes credit ratings a vital tool for anyone involved in lending or investing. Credit ratings are not limited to just companies. They can be assigned to any entity seeking to borrow money, including state authorities and sovereign governments. The scope of credit ratings extends across various financial instruments such as government bonds, corporate bonds, certificates of deposit, and even complex securities like mortgage-backed instruments. This wide applicability makes credit ratings a universal language in the world of finance. Significance of credit ratings lies in their ability to provide a clear, unbiased view of a borrower's financial health. Investors, lenders, and regulators rely on these ratings to make informed decisions. A good credit rating can open doors to cheaper borrowing, while a poor rating can signal higher risk. In essence, credit ratings help maintain transparency and trust in the financial system. Credit Rating Agency, or CRA, is a private company that evaluates the creditworthiness of large-scale borrowers like companies or countries. These agencies assign ratings based on their analysis, helping investors and lenders gauge the risk involved. CRAs play a crucial role in the financial ecosystem by providing independent and expert opinions on the ability of borrowers to repay their debts. Credit rating agencies typically focus on rating the creditworthiness of issuers of debt obligations, such as companies and governments, rather than individual consumers. The instruments rated include government and corporate bonds, municipal bonds, preferred stock, and collateralized securities. By doing so, CRAs help investors assess the relative risk of different investment options. Credit ratings are based on a thorough assessment of the issuer's capacity to repay. Agencies rely on financial data, expert analysis, and standardized symbols like AAA or BBB to express their findings. These ratings are not recommendations but serve as guidance for investors, helping them understand the risk profile of different financial instruments in a simple and accessible way. Credit ratings serve several important functions. They provide unbiased opinions to investors, offer dependable and quality information, and present findings in easy-to-understand language. Ratings are often published in financial newspapers or made available at nominal cost, making them accessible to a wide audience. This transparency helps investors make informed decisions without needing to conduct their own complex analysis. One of the most valuable aspects of credit ratings is their role in guiding investment decisions. By assessing the risks associated with different financial instruments, credit ratings help investors choose where to allocate their funds. This not only benefits individual investors but also promotes financial discipline among companies, encouraging them to maintain strong financial practices to achieve higher ratings. Credit ratings also play a role in shaping public policy on investment. Regulatory authorities like SEBI and RBI use these ratings to set guidelines for where institutions such as mutual funds and provident funds can invest. For example, a mutual fund may only be allowed to invest in debentures with a minimum rating of AAA, ensuring a higher level of safety for investors' money. Credit ratings offer several benefits to investors. They help assess the risk involved in investments, provide reliable information at low or no cost, and offer the advantage of continuous monitoring. Ratings are updated regularly to reflect changes in a company's financial position, giving investors the confidence to make timely and informed decisions. Key advantage of credit ratings is their dependability. Since rating agencies have no vested interest in the securities they rate, their assessments are unbiased and credible. This objectivity is crucial for investors who rely on these ratings to make important financial decisions without worrying about hidden agendas. Companies that receive good credit ratings enjoy several benefits. They find it easier to borrow money, often at cheaper rates, and gain recognition even if they are lesser known. A strong rating adds to a company's goodwill and encourages greater financial discipline, which can lead to sustainable growth and improved transparency. Credit ratings also benefit intermediaries like merchant bankers and brokers. With reliable ratings available, their job of convincing investors about a company's financial health becomes much easier. This streamlines the investment process and helps ensure that funds are directed toward sound opportunities. Broader business world also gains from credit ratings. As more investors receive clear guidance, the population of investors in debt instruments grows. This, in turn, encourages companies to maintain high standards and attracts foreign investment, as international investors often look for high credit ratings before committing funds. India, the regulatory framework for credit rating agencies, is robust and comprehensive. The Securities Exchange Board of India, or SEBI, is the primary regulator. SEBI introduced the credit rating agencies regulations in 1999, making India one of the first countries to establish such a framework. These regulations cover everything from registration and obligations to disclosure and conflict of interest. To operate as a credit rating agency in India, companies must meet strict registration requirements. They need to be promoted by experienced financial institutions or individuals with significant net worth. Additionally, agencies must have adequate infrastructure and professional staff to ensure the quality and reliability of their ratings. Credit rating agencies in India are required to operate with integrity, professional competence, and independence. They must comply with SEBI's code of conduct and continuously monitor their ratings throughout the lifetime of the securities. This ensures that ratings remain accurate and relevant as market conditions change. Transparency is a key requirement for credit rating agencies. SEBI mandates that agencies maintain detailed records of their ratings, decisions, and methodologies. These records must be disclosed in a specified manner and preserved for at least 5 years, ensuring accountability and enabling regulatory oversight. Maintain objectivity. SEBI regulations require credit rating agencies to avoid conflicts of interest. Agencies cannot rate securities issued by their own promoters or associates and must keep a clear separation between their rating activities and other business operations. This helps ensure that ratings remain unbiased and trustworthy. SEBI's regulations also emphasize accountability. Credit rating agencies are subject to internal audits, must submit information to SEBI when required, and are open to inspection and investigation. If agencies violate regulations, they can be held liable under the SEBI Act or related rules, ensuring strict enforcement of standards. After the global financial crisis of 2008, SEBI reviewed and strengthened the regulatory framework for credit rating agencies. New guidelines were introduced to enhance transparency, improve internal audits, and require more detailed disclosures. These changes aim to address concerns about the role of CRAs in financial markets and ensure greater accountability. Initially, SEBI regulated only the rating of debt securities. However, as credit rating agencies began rating a wider range of instruments, SEBI expanded its oversight. By 2012, regulations covered bank loans, overdraft facilities, and other financial products, ensuring that all rating activities adhered to high standards of transparency and integrity. In 2016, SEBI issued further guidelines to enhance the functioning of credit rating agencies. These included requirements for public disclosure of rating criteria, standardized press releases, and greater accountability for rating analysts. The aim was to improve transparency and ensure that investors had access to clear and reliable information. India is home to several prominent credit rating agencies registered with SEBI. The major players include CRISIL, ICRA, CARE, Fitch India, Brickwork Ratings, and SMERA. Each of these agencies brings unique strengths and expertise to the market, helping to maintain a robust and competitive rating environment. CRISIL, established in 1987, was India's first credit rating agency. Headquartered in Mumbai, CRISIL is known for its independent opinions, data-driven research, and innovative solutions. With operations in several countries and a majority stake held by Standard & Poor's, CRISIL has set high standards for the industry. ICRA, incorporated in 1991, is another leading credit rating agency in India. Based in New Delhi, ICRA was set up by major financial institutions and is now majority-owned by Moody's. It operates as a public limited company, providing professional and independent credit ratings across the country. CARE, set up in 1993, is India's second-largest credit rating agency and is headquartered in Mumbai. It is also a partner in the International ARC Ratings Agency. ONICRA, based in Gurgaon, focuses on ratings, risk assessment, and analytical solutions for individuals, MSMEs, and corporates with a pan-India presence. The credit rating process in India typically begins with a request from the borrower or issuer company. An agreement is signed, and an analytical team is appointed to gather information and assess the company's financial position. This team interacts with company officials to clarify details and understand the business environment. After the analytical team completes its study, the findings are reviewed by an internal committee of senior analysts. The final rating decision is made by a rating committee, often comprising directors. The assigned rating is then communicated to the requesting company, completing the process and providing a clear assessment for investors and stakeholders.